gold is attracting most of that initial capital. But what really drives gold right now is central banks. And central banks are doing most of the buying, and it's been great. But if you look at from those lenses as well, central banks still own sub 30% of their balance sheets in gold. And historically, we have seen in the past well over 70 to 100% of their balance sheets being held by gold. I think you need to think about silver now. And that's the transition of the metal currently is mostly into a monetary demand. Either central banks could start buying silver. And I can certainly see that. In the past, that used to be the case. Central banks used to own silver in their balance sheets. You know how much they own now? Close to none. And so, that could be a major, major shift of demand that nobody's seen. And I do think that that's a very, very strong potential tailwind for the metal. Now, what actually attracts me the most outside of the demand, of course, I mean, there's demand for solar panels, which kind of in my view, just put a floor on the silver price.
Silver may be approaching a major transition, according to macro strategist Tavi Costa. While gold continues to attract large inflows, driven primarily by aggressive central bank buying, gold still represents less than 30% of central bank balance sheets, far below historical levels of 70% or more. Costa argues silver could be next. Historically, central banks also held silver, yet today their exposure is nearly zero. A renewed shift toward silver as a monetary asset could unleash a powerful, underappreciated demand shock. Combined with steady industrial demand from solar panels, this potential monetary reawakening may place a durable floor under silver prices and fuel significant upside. Now, we present the clips from Tavi Costa's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
We saw silver in particular over the last few years. Do I suspect that we'll continue to grow the demand on industrials? I'm not as bullish on that. I think you need to think about silver now. And that's the transition of the metal currently is mostly into a monetary demand. Either central banks could start buying silver. And I can certainly see that. In the past, that used to be the case. Central banks used to own silver in their balance sheets. You know how much they own now? Close to none. And so, that could be a major, major shift of demand that nobody's seen. And I do think that that's a very, very strong potential tailwind for the metal. Now, what actually attracts me the most outside of the demand, of course, I mean, there's demand for solar panels, which kind of in my view, just put a floor on the silver price, right? If silver prices go back to $20 an ounce, which I don't think will be the case, I think, if you're a solar panel company, you would be jumping on that opportunity because you know that that's an opportunity. And look, I think that the genie is out of the bottle right now on silver, and a world that we lived in where metal prices used to be very cheap, I think is behind us. Of course, after 10 years, 15 years, we're going to go back to a cheap world of metals at some point. I don't know when, but we will. But in the next 5 to 10 years, I just don't see that. And I think there's an opportunity there first. I think that a lot of people are thinking that silver will mean revert and go back to other I think it's totally plausible to see a support at $50 an ounce or maybe $70 an ounce. And that is not the world that the mining sector is pricing in today. The world of mining is pricing that silver prices will go back to $20 an ounce. And I just don't think that would be the case. And so there's lots of opportunities on that repricing of the idea of seeing long-term metal prices higher than or elevated in historical standards. And I should also point out on silver specifically is what are things that should really change the price here? One of the things we tend to see is that after a big run up in prices, you tend to see production follow. And it's not like the silver prices have been, ran up, just recently. Like if you look at the price of silver over the last few years, call it over the last decade, lots of ups and downs, but it's been in the upper trajectory. And that alone should have driven the supply side much higher in terms of production and other things. And we're not seeing production rise. Production, in fact, is contracting. And that is something that is really concerning because we also know that we have not seen enough discoveries of silver as well. So I think that that's a real problem and that people are not paying attention to. Capital spending, for instance, look at how much silver mining companies are spending in terms of, deployment of new mines and new projects to come online. They're not spending enough money relative to the metal. If you looked at, just use gold as your inflation gauge. Look at capital spending relative to gold. We're at all-time lows today. And that is not a peak of the cycle, metric. I think the most important way to think about that is, consider the fact that most of these silver companies have, metal prices have a big run up. Do you prefer buying silver, $80, $90 an ounce, or do you prefer buying a mining company today that can produce at sub $20 an ounce cost, right? Yeah. Like every dollar that goes up right now is an increase of margin that people are not really considering. And to me, that is just nirvana. It is the best thing in the world to be, in my view. And of course, I could be wrong. And I think the market is overly pessimistic about future prices of silver and therefore why most people are behaving the way they are and not deploying capital in the silver mining industry. If you look at the silver mining industry relative to silver prices, you will see that the ratio has been collapsing recently. They are not keeping up with the silver price themselves. And I just don't think that that would be a continuation of a trend. I think that reminds me a lot of how miners were lagging gold prices themselves. Like I remember seeing I was buying call options on Barrick and Hecla and, all these senior companies. Hecla would be not the greatest example because it's a silver company, but think of mostly of Barrick, for instance, would be a great example where people were just losing faith that silver prices or gold prices were rising and the senior miners were not following. But what happened after that? We saw a major follow up on Barrick and other companies really taking off after that. And the implied volatility of those options was just not pricing in that type of upside volatility that we saw. And that's sort of the idea here with the junior miners. But junior miners, I wouldn't necessarily consider this from a derivative standpoint because they are almost derivatives themselves in terms of how much they move.
Silver is undergoing a structural shift from an industrial metal toward a monetary asset, and few investors are prepared for it. Demand growth from solar has already placed a floor under prices, but the real upside may come from monetary demand, possibly even central banks, which once held silver and now hold almost none. Long-term metal scarcity, declining production, weak discoveries, and historically low capital spending signal a looming supply crunch. Despite higher prices, miners remain priced for $20 silver, creating a major valuation disconnect. With margins expanding and mining equities lagging the metal, silver and silver miners may be entering a powerful repricing phase. Let's get back to the interview.
Logically, the mining sector is tightly related to gold prices. And so understanding the gold price and where we are in terms of that, it's absolutely critical to understanding where we are in the mining cycle as well. I think gold is still, believe it or not, it's at pretty much at all-time highs nominally, but relative to money supply, relative to where credit is globally, we're nowhere close to where we could be in the future. And so that to me gives me enough conviction that this rotation out of very expensive, overvalued financial assets into hard assets is at its early stages still. And I can measure that in many ways. You can look at, for instance, the gold to S&P 500 ratio. We're still close to levels that we were back in the peak of the 1929, back in those days before the Great Depression. By no means I'm calling for a Great Depression or anything along those lines. I just think that there is a very significant rotation happening into hard assets that people are not so much emphasizing. And as we continue to see this, family offices, pension funds, endowment funds, they still have to start really allocating capital into hard assets overall. And Commodities is going to be a big portion of that. Gold is attracting most of that initial capital. But what really drives gold right now is central banks. And central banks are doing most of the buying, and it's been great. But if you look at from those lenses as well, central banks still own sub 30% of their balance sheets in gold. And historically, we have seen in the past well over 70 to 100% of their balance sheets being held by gold. So I would not be thinking that this is, a near-term, peak of the cycle, anything along those lines. We can see corrections and all those things will come and go. But think of this as the kind of the S&P 500 trend, after the tech bust or after the global financial crisis. We're kind of in that stage where things are just getting momentum, awareness, but we're nowhere close to the end of this, in my view. Look, I think there's a lot of focus from some investors on when will the S&P 500 and equity markets overall start correcting in order to allow that capital outflows to come into gold and other things. I'm not too focused on that because where we are today, we have to think about one thing, and that's a very possible scenario. But the reason why I'm not too focused on this is because there's a few options that policymakers have. And very few, actually, I should say two options that policymakers have when you reach this level of indebtedness. And although debt is not as relevant as the burden to service that debt. The burden to service a debt is way more relevant than the debt itself. Once you reach the levels that the U.S. have reached, which is about 4 to 6% of your GDP, that range is so critical. Throughout history, when you hit that range, monetary policy becomes, well, I should say, policymakers that are looking at monetary policy become irrelevant. Their view on inflation, their view on unemployment, who cares? It's not about that. It's about reducing rates to allow the government to pay its debt. And I don't care where inflation is. Inflation could be rising. Inflation could be declining. Unemployment could be rising. Unemployment could be declining. Who cares? Interest rates need to decline for one reason. The government needs to afford the debt and also reduce that burden in order to continue to invest more in the economy.
Gold's role in the mining cycle is central, and its long-term setup suggests the hard asset rotation is still early. Despite trading near nominal highs, gold remains historically cheap relative to global money supply, credit growth, and financial assets like the S&P 500. This signals an ongoing shift away from overvalued financial assets toward commodities. Central banks are leading the move, yet still hold under 30% of reserves in gold versus 70% plus historically. With debt service burdens forcing policymakers toward lower rates regardless of inflation, monetary conditions increasingly favor gold, miners, and hard assets, pointing to a cycle that is building momentum, not peaking. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.